Bank of America customers report problems with their accounts, missing money, fraud concerns, and a long list of other risks threatening the banks right now, as they all face added risks and post SVB collapse, while the U.S. Treasury worries about possible contagion and widespread systemic risk. But perhaps the biggest risk is a threat and big problem from within the banks, and not so much the damage that could be a result after billions of dollars of deposits are withdrawn from the system after mass bank runs could potentially bring this fragile fractional reserve banking industry and mental construct to its knees. So, I want to explain to you all what happens when banks like Chase Bank, Bank of America, Wells Fargo Bank, PNC Bank, and other banks decide, and credit unions too, to close your accounts, and sometimes without warning, and what I am preparing to do to stay safe and protected. Accounts at risk include, but aren't limited to, non-traditional accounts and informal businesses, as well as informal personal checking accounts, savings accounts, their connections, and the delinquent and or dormant credit accounts. Ironically, Wells Fargo has made the news numerous times. I've brought to you several updates on this matter from personal and business, and a combination of the two, where Wells Fargo Bank, although they make the news quite often for less than stellar reasons, not much that I would want to brag about as a bank or as a business, for the wrongdoings and the fines that they have to pay for the illegal banking activities that they engage in, unethical. But they were at one point flagging accounts that were deemed informal, business accounts in great standing over multiple years, decades, between the businesses and the personal account holders. But if they found a problem with the business, they would shut it down. If they found a problem with the person, they would shut those accounts down. And any accounts tied to lines of credit, credit cards, savings, checking, business, personal, they would shut them all down. There was no separation. There was no separation whatsoever. Additionally, delinquent and or dormant accounts almost carry the same risk factor and determination by these banks. Delinquent for obvious reasons. They're less than qualified. They're subpar. And although the banks, if even allowing these accounts to engage in financial business transactions with the bank, they charge them higher interest rates. They charge them higher fees, more fees. But there comes a point of which they'll reach the point of diminishing returns. Therefore, it doesn't matter how much they charge them in interest or how high their interest rates and APRs are, how many fees they tack on. They know that they're never going to get that money because the account is delinquent. The account holder, the business, doesn't have the funds, and either it will stay that way, it will be an added cost to place in collections and try to receive these funds, and or there will be a bankruptcy in the near future, and the bank will have to take whatever it can get at that point in time. But delinquent accounts that are high risk and potential problems for these banks aren't the only ones that the banks want to distance themselves from. And this is where a story comes in, where I came across just the other day, a bank of account holder had their account shut down without warning, without notice, or at least so they say. Sometimes the banks give you a notification and a heads up that it's about to happen, or you're likely on the list. You've been flagged, your account's been flagged for this to happen. And sometimes they just do it. It depends on the bank. And sometimes they've notified you, but we ignore it or we miss it because there's an overwhelming amount of spam and fraudulent emails and text messages and pop-ups everywhere that we've become desensitized to the real warning signs. It's kind of funny because somebody actually mentioned that the other day about the titles and thumbnails on YouTube, and they said that sometimes I don't click on them, I don't watch the videos because I feel as though they're clickbait. So my response to that would be, but what if the title and the thumbnail is actually what the video is about? An urgent warning to help you prepare for whatever it may be, avoid potential catastrophic loss, damage, problems, anguish, stress, reduce your risk level, but you ignore it because you think that it's clickbait, and it's not. It's 100% accurate. There's nothing wrong with it, but the simple fact of the matter is it just further proves the point that we've become desensitized to traditional warning signs. And it's almost like now, I hate to say it, we may be more apt to listen to the warning after the problem. But by then, oftentimes it may be too late. However, when it comes to the banks, if your account reaches a point of which it has a long period of time of inactivity, this could potentially flag your account and put you at risk of being closed, canceled, terminated, shut down, wiped out. And this is on savings accounts, credit accounts, checking accounts, lines of credit. If there's little to no activity, the bank may just wipe that account out. Variety of reasons behind why. We'll get into that in just a moment. Then you get the high risk accounts, okay? And the high risk accounts, those are the ones that you just never know what's going to happen. They could have very little money in their account. They could have a lot of money in their account. They could have very little utilization on their credit. They could have maxed out their cards, their credit limits. They could sometimes end up triggering fees on their account, late fees, non-sufficient fund fees, or whatever. Maybe even exceed the amount of transactions, transfers in and out, because there's a limit on that sometimes between checking and savings and things like that. They could rack up fees with using out-of-network ATMs, but you just never know. And I think that right now, given the current financial and economic situation, as well as the potential risks that these banks face, perpetuated by Silicon Valley Bank, Signature Bank, the U.S. Treasury, Federal Reserve, Biden and his executive orders, they may look at these accounts and decide they want to flag them and close them. Next on the list is credit utilization or credit usage. And this is quite possibly the biggest risk for the banks because they have extended credit to customers, account holders, with no security, with no collateral. And these could be $1,000, $5,000, $10,000, $50,000. I'm trying to think of the highest credit card limit I got right now. Probably like $60,000, $70,000. But I know people have hundreds of thousands of dollars in available credit lines, credit limits, credit cards, lines of credit, personal, business, you name it. But based on the utilization and based on the usage, as well as the history and the algorithms that they use to predict and project into the future, You may see some of these accounts getting closed without warning, especially these, because again, they're non-secured, no collateral, and they're literally putting their neck on the line to allow any person at any given time to have access to these funds, this available balance to make transactions with no guarantee that they're going to get repaid. Additionally, they're checking your credit. Now, there's a difference between a hard pull and a soft pull on your credit. And ultimately, what these banks are doing are running soft pulls on your credit just to take a peek, just to see what's going on, just to see if everything's okay, just to see if you are equal to and or better than what they saw on your credit report, your credit score, when they approved you, when they opened your account, when they provided you and extended you credit. Now, there was a time where you, in my experience, the banks would just give you higher lines of credit. The banks would offer you greater perks, access to different accounts based on your credit, your personal credit score, your FICO score. And granted, this may change in the future to a different social credit score, but that's a different video. And they would just give you more and more and more because they wanted you to spend more, charge more. They earn fees for this. They could potentially earn interest off of carrying balances, et cetera, et cetera. But now I think they're more so looking to reduce available credit limits by doing these soft peeks behind the curtain without you knowing, really, that have no real bearing on your credit score like a hard pull would, to continuously reduce their limit their risk, mitigate their risk, lower their liability. With these peaks, they also have the ability to share information back and forth between different bureaus, different agencies, different companies, a variety of factors, some of which we actually provide to them. I think it was Experian or TransUnion, one or the other, or maybe all three, Equifax, offered the ability for people to add information to boost their credit score, their FICO score. You could add payment history to utility bills and other non-traditional forms of credit, rent payments, all these other factors and indicators that can help the algorithm really determine who you are and calculate almost to the 100th or 1000th percentage of chance of default, chance of late payment, chance of the bank making money off of you and your account, or potentially eating it and losing money. It's all a risk. It's almost probably worse than Vegas when you think about it, the way these banks operate. But either way, they take peeks behind the curtain through a variety of different algorithms and shared information, some of which may not necessarily be ethical and or legal, but we'll wait. We'll wait and see for the next Wells Fargo scandal to be unveiled, which will probably be the first indicator of how they're acquiring this information, which could also be provided by employers. It's amazing how many different applications or different experiences that you may come across require your social security number. Car insurance needs a social security number. Your credit score has a lot to do with your car insurance rate, by the way. Just let you guys know. But they're sharing private information between the banks, the creditors, the lenders. All these play into a long list of factors that will ultimately bring the bank a notification, an alert based on these algorithms, because there's not real people sitting here doing all this calculation. This is being done by AI, automation technology, parameters set into the system, where when 1, 2, 3, 4 different boxes are checked, they trigger an alert. It could automatically flag you. It could automatically ding you. It could automatically lock you out. It could automatically shut your account down, cancel it, close it, wipe it out, or send an alert. up a tier or two to a manager to then make the call, make the decision. Maybe it automatically populates a message and generates a letter that you may receive in the mail, or an alert when you sign into your banking app, or a phone call or a text message. Unfortunately, as I said previously, we ignore most of these messages because we've become so used to and accustomed to fraud and scams that we've been desensitized to the truth. However, in the particular story of the young man who had his Bank of America, I believe it was Bank of America account closed, it was due to inactivity. And the bank determining that the amount of available credit on his credit card in comparison to his utilization and usage history, probably in conjunction with his income and his credit score that they can see from behind the curtain, they close the account. Comment down below if this has happened to you. Not necessarily for those reasons, but comment down below if you've had an account closed with a bank or a credit card company or any lender or financial institution for that matter. Because Chime, think about it, Chime, I did a video on Chime. They're not a bank. They're a financial service provider, okay? So if any of these banks, creditors, credit companies, credit card companies, lenders, financial service providers, if they've ever just abruptly closed your account or maybe sent you a notification, comment down below. Now, moving forward, I myself am not immune. As I bring you guys this content and this information, hopefully it's helpful and useful to you. I am not immune to what happens and what could happen with these banks and with their algorithms and with the decisions that they choose to make. But much like everything else, I have a plan and a strategy. I'm going to share that with you. Number one, I'm going to continuously monitor my accounts. I'm going to continuously monitor my accounts. I'm going to monitor the correspondence and messages that I receive, emails, letters in the mail. I'm going to monitor them just to make sure that I don't see anything funny going on, okay? Somebody asked me, and they said, well, I've paid off all my credit cards. Should I close the account? Well, it kind of depends. So let me just break it down to a real simple, easy thought process. If I opened a credit account for a particular reason and it came with a particular benefit or perk, and it didn't cost me money to keep it, I would probably leave the account current. I'd leave it open. However, if I did that and it carried an annual fee or an annual cost or membership or anything like that, and I wasn't taking advantage of it greater than what that annual cost was, then I would probably close it. But the key is depending on understanding, identifying, preparing for what is your long-term goal. Because if your long-term goal involves leveraging debt and credit in the future, the longer you have accounts open, the higher your utilization or your available credit is in comparison to your utilization will only really, based on past metrics, I don't know if they're going to change it moving forward, help your scores, help your approval ratings, help your credit worthiness is what I've experienced, what I've seen. Granted, they could change this in the future with this new social credit thing they got working. So if I paid off a card, would I close the account? Probably not, because I don't have any cards with annual fees. And the higher my available credit, the better my credit score is in theory, especially if I then choose to use one. I'd rather have $100,000 of available credit and charge $10,000. That way I've got a 10% utilization than have $10,000 of credit and charge $10,000. Now I got 100% utilization. That makes sense. I will continue to add security. Remember, diversity, security, and cash flow. The security comes in a variety of forms, one of which is my own security of just monitoring and paying attention and not ignoring the warning signs. But part of this added security can be setting limits on my daily charge amounts, setting limits on my daily withdrawal amounts, setting limits on account balance notifications in case I get a low balance and I can avoid a overdraft or anything, setting security where my savings may automatically protect my checking from an overdraft if anything were to ever happen. Added security by using credit cards, in my opinion, more so than cash or debit. Credit cards, in my opinion, add a greater layer and level of security. Utilizing services like locking my credit and protecting my identity, things like that. However, at the end of the day, I want to continue to keep my debt low. I don't want to pay interest. I don't want to waste money. I don't want to feel the burden of always having to owe unnecessarily. I don't mind owing, knowing that I have the cash to pay off the debt, but I'm borrowing because it's cheaper. The interest rate on the credit line extended is completely negated by inflation. It allows me to use my capital, my resources, my cash in other ways to make even more money, while also increasing my diversity through banks, through lenders, through credit card companies, through security measures, through businesses, diversity, security, cash flow. The banks are going through some crazy stuff, folks. And, part of the problem is within, part of the problem is external forces, part of the problem is the economy, part of the problem is legislation, and part of the problem is are the account holders. Last thing I want to do is have my accounts closed, canceled, frozen, shut down, or wiped out. But I feel as though if I continue to monitor and maintain and secure and diversify, I think I should be fine. I think I should be safe. And I think that if anybody else were to do that, they would probably be in the same boat. Unfortunately, the path that we're on, this economic roller coaster, this journey through this recession, through levels of high inflation, job insecurity, crisis, panic, anxiety, worry, fear, stress, you name it, whatever you want to label it, however you want to describe it. I don't think that now is the time where we can really put it on cruise control. But what we do doesn't have to be extremely overwhelming and carry a huge burden. But we probably do need to be mindful of what's happening, what could potentially happen, protecting ourselves, and planning and preparing for the future. I appreciate you guys watching. I hope this information is of value, helpful, beneficial, entertaining, maybe even at the very least. Please give this video a like, subscribe to the channel if you haven't already, turn on your alerts, notifications, share this content with anyone you think will be helpful or beneficial to. Comment down below questions, comments, concerns, 100% free links in the description down below. Until next time, you guys take care, be safe. I'll see you real soon. Bye.